Well, hello, friends, and welcome to the From Busy to Rich podcast, where we help financial advisors grow their businesses beyond the products they sell and the assets they manage to increase profitability and reclaim their time by providing strategies and insights that will not only change your life, but practice. With me, as always, Wes Young. Really excited about today's topic and conversation. We've been building on this idea of designing an onboarding process that's worth talking about. We talked through some of the location, and what you're doing is what some people might refer to as that fact finder, that where are we currently? And then moved into the expectation phase in the last podcast. If you haven't had a chance to listen to those, highly encourage you to go back. That's really what we're talking about. What would this look like? What does it feel like? Kind of like you're going to the retail store and you're going to buy a jacket. How do we try this on and create an experience like that to really see what it would be like to wear this in a relationship moving forward? But then some of the concepts and things that we talked about are high level or advanced potential opportunities that are there that are fitting for the client potentially, but wouldn't know unless you were to engage. And how do you deliver upon that? And that's really the focus of today's conversation. So with that, Wes, I'm going to hand it off to you. Let's dive into what does it look like for us in that next phase, someone's engaged, and now how we're going to deliver on what we discussed.
Yeah, well, we call this one, Justin, the direction phase, because there is so many paths to, if you want to go from where I am in Austin, and I want to go to New York, right? There's a lot of routes I can take and a lot of ways I can get there. But just because there is a variety of routes doesn't mean all of them fit with my unique makeup and my tastes and the other things that I care about. I may want to make some stops on the way that may be important to me. There may be weather in the clouds, and I need to know what I'm going to do if I encounter that, if I'm flying there. So there's lots of paths, but in the world of financial planning, this is where we mentioned this quote last time. As Ben Feldman said, we come into this business in a state of starry-eyed enthusiasm, and we educate ourselves to a place of sophisticated confusion. Now, the best in the world emerge to that side of mature simplicity. So what we want to do is approach this in a way of mature simplicity. You can't go through every possible idea with a client, nor should you. And even if it all was relevant, there's just so much in one single sitting, it doesn't make sense. So what you're going to do, you've left this, they've agreed to move forward. So you've gotten, your team took care of the electronic fee agreement. You've sent out the first strategy summary, and that first strategy summary says what's in progress, what's upcoming, and what's on hold. And one of the first things that lives on everybody's strategy summary is we need you to securely upload these documents. And that's going to be things that you're going to want in all their areas of planning, like past tax returns, if they have statements, if they have buy-sell agreements in their business, what wills or trusts do they have already? Anything at all that's going to be relevant to all these big areas of planning, meaning income, assets, and heirs, in the story they're navigating about money and the life they're coming from and the life they want to live. And so you kind of go through and we sit back and we just think, okay, what are the things we want that are going to help us do the best job of kind of having more context as we're going through the planning process with this client? And then you're going to begin to set regular meetings. We like to try and meet every other week early on because there's usually enough to talk about. And most clients are going to follow a similar pattern unless you're really close to a tax deadline or they've got something that's big in their life that they were like, I want to address this first. And so I'll give you kind of the normal order of things. So again, all these meetings, regardless of what we're talking about in them, all of them have our big areas. One is we always have the meeting before we have the meeting. So you're going to go through in your head, okay, what is in this, 45 minutes of time, they can go an hour, but I really like to keep them to 45 minutes because you start losing some attention span and their ability to internalize. And then what are the things we want to talk about first and set up for the next time we're together. And so you're gonna have prepared yourself for that. Again, we love using screen recordings, the Mind Vault method, where as you've prepared or your paraplanner's prepared for, hey, here's the strategy summary, here's what's coming next. They recorded themselves when they were at their best the week before that meeting. And then you watch it Monday morning and you go, oh, I like that. Or let's add this in there. Or we don't even have those documents yet. So it's really tough to have that conversation. Let's move this up in the chain of things we're going to talk about. So it's literally having the meeting before you have the meeting. And also it makes your week way less administrative and far more creative in how you're dealing with the upcoming meeting. So in those meetings, typically it's going to be going to follow this pattern. So in the next meeting we're having with them, we're going to renew their mind to their balance sheet. Say, hey, look, so we added these things, we updated it for you because now we're in the welcome common ground, healthy tension next step. So we're going to say, hey, in today's meeting, I've got about 45 minutes of time allocated. How are you on time? And because remember, this is going to be the direction phase. So you got it. This is about picking a path at some point. But you still want to let them know what's coming because they've not been through this process before and certainly never with you. And so you're going to say, so today we're going to start picking some paths because there's hundreds of great planning strategies, hundreds of thousands of combinations of them, but likely only a handful that are going to be relevant in each season of your life. So we're going to methodically go through these over the next several weeks together and begin checking stuff off and actually moving things forward. So first is we're going to go through the balance sheet, make sure it's accurate. Then I want to move back over to the whiteboard and just recap what high level we talked about last time. And I'll use the same drawing when I do that, Justin. So I'll talk about that in a second. And then we're going to dive in specifically to one area. I know we're still waiting on your tax returns, and that's really going to help us prepare your tax intelligence plan to coordinate with your CPA. So please get those to us. So you're also letting them know stuff you need, right? And then you're going to say, and we still need your will and trust documents as they are today. So we can best, when we're talking about unleashing the generational potential, like what's the best structures we want to have in place for that? What do you have now? And then, but today we're going to spend a lot of time on that thing we call the family bank. And so normally that's one of the first things we end up talking about with the client is all of their liquidity, right? But you remember, you don't just want to jump right in because the people you're trying to lead need to feel the weight of the problem you solve or the opportunities you help seize before they care about all your strategies and processes and techniques to do it. So you're going to remind them of the story they're in about money and the story they're living now and the unlived life yet within them, because that's really the why before you get to all the what. So, and hopefully there's outcomes. There's picking a path here. So here's what a common one might look like when we're talking about the family bank. Say, so Justin, I've allocated about 45 minutes of time today. You get on time. And what we're going to do is I'm going to first just renew your mind to your balance sheet. We made it those updates that you gave us last time. And then I want to go back to that pie chart discussion we had last time and where we outlined all those areas. I'll just pull it up from the last time because you've got a digital whiteboard, so it just saves it. And then I want to tell you what we need on some other areas that we haven't yet gotten from you. And then I want to focus in on this one area we call your family bank and what role it plays for you and kind of how we need to allocate it and style it to match well with what you've got going on with what matters to you. And then you dive in. So you go through the balance sheet, then you're going to pull up that whiteboard and then you're going to go through high level. Remember so number one is you had to create a healthy income and you create 500 a year and then several things are happening to the money. One is taxes. The tax system gets involved with it. So we outlined all these examples for you of things that may be necessary to maximize your tax intelligence plan for us to coordinate with your CPA. What we still need from you on that is your tax returns from last year, because that really helps us level set. So you remember this strategy summary? We'll show them the strategy summary. Did you get that? Yeah, I got it. See, you just click that link and we've got a list here of all the things that would be helpful for us to have. We did get some of your statements, so we appreciate that on your investment accounts and your savings accounts and 401k. But we still need those tax returns to really focus in on this one. So that's kind of on hold until we get that. Then the other area that we talked a lot about was that you're spending money, and we talked about how long is it going to take you to get where you want to go based on some assumptions, and how much do you need to have? And you remember what that was? What do you remember about that? And I'll often use those words because now you go from first time teaching to second time making sure they've learned what was taught. And one of the best ways to do that is by saying, what do you remember about what the role of the family bank is? Because you're saving money into it every year. Why? Well, because one day, if I'm still working, I want it to be because I want to, not because I have to. You want work to be optional. And you'd like to keep it that way once it already is. Doesn't mean you'll stop doing it. You love the work you do. It's a big part of your purpose that you're out there doing in this business that you own. But it's a lot more fun to work because you want to, not because you have to. And there's so much going on with the family bank. Yes, we want to get it to a place in light of the fact that markets move up and down, in light of the fact that there are recessions and there's interest rate hikes and inflation and tariffs and all these different things that are going to affect this. What is a good approach for you in your family bank? So we're going to spend the majority of our time there today. And then what else does it need to protect and help you take advantage of in other areas of your life? Things that you want to go buy, things that are important to you and your family, the life you're living now, things that are important to how you're growing your business and opportunities that may emerge. How do you want to use this to really unleash your human potential as you live here? And then that third area was all about how do we unleash generational opportunities, generational potential. If something happens, if you live a long time or if you pass away tomorrow, what are the ways we're going to do that? So we're going to talk about that. Now, we're going to talk about what probably won't get to that one today, but right now, and I know you had a lot of questions about this, we're going to jump into the role of your family bank.
Hey, thanks for tuning in to From Busy to Rich. If you're listening and something sparks a question or you just want to explore these ideas further, visit us at wesyounglive.com or email us at info@wesyounglive.com. You'll find free resources, tools, and ways to get in touch. We'd love to hear from you.
And Justin, that's where we're going to go through our variable fixed discussion, where we talk about how, and just as a again, this is not going to be exhaustive, but I want you to have enough to know what we're talking about here. So if you think about this, that piece of the pie, it's going to have variable assets or it's going to have fixed assets. And this is your liquid assets, right? So variable assets are things that move up and down in value. So if you think about the S&P 500 index, it moves up and down on a daily basis. Now, over time, it moves up. But any day to day, it could be compressed or it could be expanded. And the market sets the trade-in value on that any given day. It's like doing a yo-yo while you're walking upstairs. And sometimes the yo-yo holds for a while before it drops, but it always drops. And then it always comes back. And so that's true of all variable assets. And bonds are variable. I recognize we have a lot of financial advisors listening. So they say, no, we call bonds fixed income. Yes, but they are variable in their trade-in value. So if you owned bonds before interest rates started being raised, you learned really quick that while that bond may have paid you a consistent coupon rate of 5% and you bought it for $1,000, all of a sudden, if you looked at what the value it was on the market after interest rates rose and new bonds were being issued for $1,000 paying 6%, nobody's buying your bond for $1,000 in that market. And so you'd have to sell it at a discount. So they do move up and down in value. So you have variable assets, and so does cryptocurrency and all different kinds of, gold and silver and those things. Then you have fixed assets, and we draw the line, they're just going to grow at kind of this consistent up. Now, over time, your variable should absolutely outpace the fixed because it's day to day. You don't know what the value is going to be, and you should be paid for that temporary risk that it could be worth a little less than what it was the day before, or in some cases, a lot less. So yeah, long-term, we better get more up there, but it's the dance between these two asset classes that matter. And so we talk about that. And we talk about how if you were 50% variable and 50% fixed, and let's say the markets go through a compression cycle. So now they're trading at a discount like they were, we record this right now in 2025. And by the end of the first quarter of 2025, markets were trading at a discount from what they were at the start, and they started coming back up, and now they're back at a high again. But it was a temporary compression of about 15% year to date. And when that happens, you're 50-50 because your fixed is just going up, hopefully by 4 to 5% a year, and hopefully it's tax efficient. We'll get to that in a second. But your variable is it's going to be like now selling at a discount, even though you still own the same shares that you owned before, or you still own the same bonds that you owed before. What the market's willing to give you for those is discounted from what it was at the beginning of the year. So when that occurs, you might be now not 50-50, but 25-75 because of the change in value to your trade-in value to your stocks and bonds. When that happens, all we're going to do is move opposite of what the masses are doing. We're going to push enough money from the fixed into the variable just to put you back to your disciplined standard of care. And clients remember those words, disciplined standard of care. And in this case, 50-50. And so you're buying when markets are in a compression cycle, when they're down from their previous trade-in value. And this isn't market timing, it's just math. And the fascinating thing here is human behavioral economics oftentimes makes people do the exact opposite of this, which sounds crazy because you're supposed to buy when markets are low and sell when they're high. But here's what happens is you go onto your online account or you get a paper statement if you're still getting those. And all of a sudden you look and it says right there on the front page or the home screen, the trade-in value of your stock and bond mutual funds or stocks and bonds. And you're going, I just lost $150,000. Well, you only have lost it if you sell at a discount. Just like if you bought a piece of real estate for $100,000 and the next day somebody came up to you and said, I'll buy it from you for 75. You would go, well, no, I'm just going to wait until somebody will give me the right price for it in the event in that. And never else, if there was a piece of real estate selling for 100,000 that you wanted, and the next day it was on sale at 75, you would want to buy it. But for some reason in the publicly traded markets, people like to do the opposite because they're scared. They're thinking in terms of, I just lost money. No, it's temporarily trading at a discount. This is actually a really good thing. You should be excited about it because that's why we have fixed money. And we're going to push that fixed money in. And instead of buying 1 share of stock, we get 20 shares of stock, depending on how deep the discount is. And then what's going to happen is the opposite when markets expand, just like they have this year after that first compression cycle. They expand back, and now you're not at 50-50 that you reallocated to. You're now at 75-25. So 75 variable, 25 fixed because of how quickly the variable grows. And when that happens, what do most people want to do? Most people are like, hey, oh, this is great. We should take more fixed and put it up here. And that's contrary. That's buying when markets are accelerating, when they're on a high. And they could accelerate more, right? But this is about discipline. And so this is about having a disciplined standard of care. We're just going to scoop some profit to put you back to 50-50, to your disciplined standard of care. And when you do that, you're automatically buying when markets are contracting and selling when they're expanding. And so you get them to agree on that. And then you can say, now let's talk about what you have in these accounts. You've got this account, this account, this account. What we would recommend is you think about this allocation for this money based on your risk tolerance and based on the other stuff you have going on. Generally, that's where you're going to go ahead and say, we can do that for you. And here's what that would look like. And most clients are going to go ahead and just move that money over because they agree with the philosophy. Then you're going to talk about the fixed assets. And we've got whole podcasts on this. And in Transform, we teach these asset selection conversations very specifically, where you can use things like overfunded whole life insurance contracts to store your fixed capital that is going to grow at 4 to 5%. It's going to grow tax-free, creditor protected, and you don't have to be age 59 and a half to get to the money, and it has no market volatility. It's a very tactical asset in there when it's explained right and people fund it correctly. So we talk about positioning, and we usually have, after this meeting, like action items on the books. We're moving this account here, and then we're going to get this life insurance asset for this fixed money, and that's what we're going to do. And so that's a very common first direction phase meeting. Again, this is accelerated massively. And of course, it's situational on every client. But thoughts on any of that before I move on, Justin?
No, I think the point is, regardless of what you are going to move forward with, it's getting very clear and concise on that. I think it's too easy as an advisor to want to feel good versus focus on the progress to deliver. It feels good to do a brain dump about all the potential things that you're seeing as these massive opportunities to improve their profitability and quality of life. But it doesn't matter if it sounds like a word salad to them.
Right.
In shooting, so I was in special forces as a Green Beret, and part of what I did as a weapons specialist, so specifically I'd run the ranges when we do foreign internal defense type training. So go down to Colombia doing joint training with the Colombian Special Forces, the Junglas, and then we're shooting. And you could see as you're shooting, their shot groups would get tighter and tighter and tighter. And then at some point, inevitably, every single time, that group starts getting wider again. We've now hit the point of saturation and diminishing returns, right? Like, it's how do you pay attention? Because continued training now will be counterproductive at that point.
Absolutely.
There's no reason. We're just wasting bullets downrange. So it's really refining down, and that's part of us limiting it to 45 minutes is what is truly important to move the needle. Because your job, or our job as planners, is to help eliminate hurdles, not create more of them.
Right.
And if it's overwhelming, like we've talked about this before, some clients, it's like they're waiting to receive that email with what do I owe? What do I need to do? What's next? Right? They want to know what's next, and they immediately get it back to you. And then other clients, especially the nature of our clients, they're business owners. They're busy. They already came to us with more opportunities and things to go after than time and money. And so, how do we help prioritize what those things are to create progress? What are the things that are truly going to move the needle the most? And then it's, hey, ultimately, yes, I want 752 documents because I'd love to have it. But you don't have digital documents or your state documents. You don't have, there's a lot of extra stuff. Let's start here. Give me these 2 statements.
Absolutely. I'd love to, I want to follow up on a couple of things you said there that I think are critical for the listeners. So remember this is fundamental. All of us are going to run out of time and money before we run out of all the ideas and opportunities we could go pursue. And sometimes what ends up happening in our effort to get the most out of life, we tend to pursue the things that scream the loudest, not necessarily the things that actually matter most. So what you're doing here with this client is regularly reminding him of, hey, here's where you are, the story you're living, and here's the unlived life within you. Here's what you want. You want to increase your profitability and quality of life. And here's the role that these things play. In today's conversation, the family bank is designed to get to a place that it produces this passive income for you of whatever it is your number needs to be. And there's a whole lot that happens inside of there. And it's designed to help unleash your human potential as it relates to your unique ability in your business. So it's like a strategic asset. We want to grow it and we want to allocate it. And we want to have fixed. We want to have variable. What ratio is totally dependent upon what they have going on. We have a lot of business owners, they're 100% fixed. And the reason they are is not because they're afraid of risk. It's because they take all their risk in their illiquid business values. And they need that based on the size of it. Eventually they get to some point and maybe we add a little variable in there. But they also might like risk that they have direct control and impact on. And so that's there. Then we have maybe a corporate executive that they're going to be mostly variable and some fixed, like 20% fixed. But either way, it's tactical when you have fixed and variable assets that can dance together. And you know what it does? It helps them stay healthy. If our job is to help people increase their profitability and quality of life, one of the things about quality of life is peace. You want to have peace. And I want to let them know in advance, markets are going to contract and expand for the rest of our lives for a variety of reasons. And when they do, here's what's going to happen is the news media, or financial entertainment networks, I should say, they're going to say it's never going to be good again. This time it's different. Here's why. 100% of the time, it's always been good again. It really wasn't different. And we just need to take advantage of what will happen hundreds and hundreds of times before you're off the planet. And that's when markets compress, we're going to take territory. When markets expand, we're going to take profit. And we're going to keep you in this ratio and have enough there to do the other things that matter to you in your life. We had a client that, this is a great personal example, that one of the things that they really cared about, one day when I get enough money saved, I really want to buy a beach house because my family, it's a big thing for us. My dad used to have one and we would go there 4 times a year as a family and have these gatherings. And, we've done that some, so a couple of things. One is, why don't you do that now? And they said, well, because I need to save all this money. I said, who told you that? And they inherited a version of what the right way to is like accumulate. And then one day after I've accumulated all this, then I can do all the things I have been deferring and enjoying. I'm like, well, why not have some, like a little bit of, I'm not saying like abandon your, if you can save no money and you have no margin, then don't do it. But, this person had $4 million of liquidity. They were making about $600,000 a year. And I said, have you ever thought, I'm not even saying that you're ready to buy it, but you can. And if you got a mortgage, what you're producing over here would pay for it. And you'd have this asset to enjoy with your family and increase your quality of life. We need to get some moments in the memory bank as well, and maybe do some of these family meetings that we discuss with you when we talk about your unleashing generational potential. And so it's holistic, right? Or, hey, let's take some money and go buy this piece of real estate. Or let's take some money and go buy this equipment for your business because it's selling at a discount right now because things are in turmoil, but you have this bank with all this fixed money. We can go after it. So it's connecting this with the story that they're in. But your clients, to your point, they're going to run out of time and money before they run out of all the ideas and opportunities they could go pursue. So what you're serving as is a point in time regularly for them to stop, be reminded about what life am I living? What is the unlived life within me? And what are some of the things I can do one piece at a time to get myself a little closer to that unlived life within me faster than if I don't do them? Because hundreds of great planning ideas, hundreds of thousands of combinations of them. We need to narrow that focus down and take it away one bite at a time. So as we kind of roll through this with them, we all then kind of end it with always, okay, here's what's going to happen next. Preston's going to reach out to get these accounts moved. Kara's going to reach out to go ahead and get you started in insurance underwriting because we're going to use that as a fixed piece of your asset class. And then next time we'll meet in 2 more weeks or 3, whatever works for the calendar. Next time, what we're going to focus on is unleashing generational potential if you live a long time and if you pass away tomorrow. And that is what we'll talk about next week on the podcast, guys, is how do we unleash generational potential? What are the common conversations? Again, for deep looks at all this, you go to Transform, because that's where we'd spend, again, 11 sessions on this and have Q&As and then the capstone event at the end and a lot of bonus material because we can just spend more time with you on it. Then with them, we've got a meeting schedule. We told them what to expect next. We said, hey, if you can, in between now and then, get us some of these other things on the strategy summary, that would be fantastic. And usually the inspiration is the deadline. They get you a lot of stuff right before the meeting, during the meeting, right after the meeting, and then they go back into their life of busyness. So that's this meeting. That's the first direction phase conversation for most of our clients.
Well, we hope you guys really enjoyed today's episode and the example. Feel free to check out some of our previous episodes. We actually walked through this type of meeting again, but with other concepts and illustrations. We highly encourage you to go check those out. Or as Wes mentioned, join us for the upcoming Transform Learning Series. We would love to have you there. You would not be disappointed, promise. Thanks again for listening, and until next time, take care.